Welcome back. Today, the market is trying to bounce back from a week that saw the S&P 500 sell off on concerns of a deepening debt crisis in Europe. But could we see a market rebound this holiday season? Jeff Kleintop helps oversee some $316 billion as chief market strategist at LPL Financial, and he joins me here on set. Jeff, welcome to Bottom Line. Thanks for coming on.
Thanks for having me on.
You are of the school of thought that one of the best strategies at the end of the year is to follow the tried and true model, and it appears in the Stock Trader's Almanac. But there's no chapter about what's been going on in Europe, no chapter about a sovereign debt crisis. What are investors to do?
Well, you're right about that. It's been an interesting year, though. Although we've dealt with these issues, the super committee issues, the debt here in the U.S. and abroad, yet the markets followed kind of that classic Stock Trader's Almanac type pattern. We had, sell in May and go away, worked perfectly this year. Yeah. Stocks peaked out on April 29th. October, the bear killer month, worked. Stocks bottomed on October 3rd. My guess is we might see a Santa Claus rally here on the idea that we make some progress in Europe, moving towards some governments that may impose some put together some austerity packages, and then just subsequent improvement in the economic data, much like we saw this morning in the LEI.
And that Santa Claus rally, those are gains in the week between Christmas and New Year's. Are consumers getting a little bit more confident? Because, as you say, the LEI number today, and we're seeing some other positive signs, it's a slow haul, but it seems to be going in the right direction.
It does. You know, one of the most important things to consumers is the job outlook.
Yes.
And we finally broken that 400,000 level on initial jobless claims. And while not everyone's watching that data as closely as we are, certainly they're feeling that maybe things in the job market have improved a little bit. That's helping them go out and do a bit more shopping. And we've started to see consumer sentiment begin to improve, come off of these recession level lows we've been at in recent months.
You mentioned the jobs picture, that increase in consumer spending. It has everything to do with an increase in household income, and that has everything to do with a decrease in the jobs picture. Tie that all together for us.
Sure. Well, we certainly have an environment where there's a lot of concern around the haves and the have-nots, right?
Yes.
And what it really comes down to is good job creation in this country. And we finally started to kind of turn the corner. This has been a sluggish job recovery.
And that figure below 400,000, that's significant. Is it not?
It very much is. You know, it's been very difficult for us to get below that level, and we've finally done that. A normal level might be around 350,000. Yeah. We're now not far from normal in terms of, now remember, this is only measuring layoffs, not job creation, but they tend to go hand in hand. And what we're starting to see is maybe more news there. So I think when we get on December 1st, that jobs report for November, might be some positive news. The market might set this market up for that Santa Claus rally.
You mentioned that deficit reduction super committee. Our colleague Peter Cook was just interviewing one of the freshman Congressman Schweikert from Arizona. The deadline is November 23rd. How do the discussions affect your strategy going forward? Because it seems with just a week left to go, there's still a lot of tension, and a lot of that has to do with a line in the sand over taxes.
Oh, absolutely. So both sides not willing to give a whole lot on this issue. Certainly the Republicans holding the line on taxes and shying away from negotiations here. Listen, I don't think we're likely to see a whole lot come out of this. You know, Congress's approval rating is 9%. It's there for a reason. I don't think the market expects a whole lot out of this super committee. So a number, maybe if they don't get anything done, at least if they get maybe $400 billion of that targeted number, might be enough that the market's not going to be too disappointed here. Remember, no matter what happens, we're unlikely to see it implemented. We've got a new Congress coming in 2015 or 2013, and that's likely to change anything that's agreed to in the next week.
Jeff, we have about a minute left. We were talking about consumers. They haven't cut back on spending. They're seeing somewhat of a resurgence right now, even with the turmoil that we have been seeing going on in the world financial markets. Is that going to put increased pressure on companies to rebuild, to restock their inventories?
It may. You know, we're watching the American Association of Railroad Traffic very closely as they look to maybe rebuild their inventory. So we can get that data weekly. That's soared. That's actually up near multi-year highs. And we're starting to see that kind of pick up. We're starting to see a retail hiring pick up. So it looks like, yes, perhaps that might begin to, generate some interest in the economy. Business leaders begin to reinvest as they see maybe a more stable outlook for end demand from consumers.
But it's interesting because you have some economists who say that increase in consumer spending can be tied directly to a fall in the savings rate.
Well, that's true, right? We also need...
It's just very confusing sometimes just to sift through all of that. Yes, consumers are spending more, but they're saving less.
Yeah, and if interest rates were rising suddenly as a result of that, that would be a problem. But fortunately, rates are remaining low in large part because money continues to come into the U.S. from overseas, not just China, but Europe as well, as they seek that safe haven. So as long as interest rates stay low and consumers continue to spend, that's a pretty good environment for a late year rally.
Jeff, could I ask you just quickly in 15 seconds, the situation in Europe, we just mentioned it before, how does that pan out? How do the new governments in Greece and Italy affect your strategy again?
Well, I think there'll be this carrot and stick approach with Germany and the ECB encouraging more austerity packages. I think we'll muddle through over the course of the next several months. Don't expect a resolution, but don't expect a crisis either.
Jeff Kleintop, he helps oversee $316 billion, chief market strategist, LPL Financial. Jeff, it's a pleasure to have you on. Enjoy your holiday. Thanks so much.
You too.